All right, let's talk about buying a house. When you're applying for a mortgage, it can feel like lenders are looking at a million different things. But honestly, there's one number they care about more than almost anything else. It's a single number that can literally make or break your entire deal.
So what is this all-important number? Well, it's called the loan-to-value ratio, or just LTV for short. This one figure tells a bank everything they need to know about how risky you are as a borrower. It's going to determine how much you can borrow, what your interest rate will be, and even if you have to pay for extra insurance. Yeah, it's a pretty big deal.
So let's break this down. What exactly is loan to value? I know it sounds a little technical, maybe a bit intimidating, but trust me, the idea behind it is actually incredibly simple. At its heart, LTV is just the percentage of a property's price that's covered by the loan. So let's say you found your dream home and it costs $500,000. You go to the bank and ask for a loan of $400,000. Well, you do the math. Your loan is covering 80% of the home's value. And boom, that's it. Your LTV is 80%. What I love about this visual is that it shows you who owns what. The bank has a claim on that big 80% chunk. The other 20%, that's your down payment, that's your equity, that's the piece you own, free and clear from day one. So really, if you remember one thing, it's this. LTV is just a simple way to measure ownership. The higher your LTV, the bigger the bank's slice of the pie is, and the more risk they're taking on. And that's the idea we're going to keep coming back to. In fact, this concept is so straightforward, you could easily explain it to a kid. So let's try a little analogy here that makes this whole thing feel completely intuitive. Okay, picture this. You really want to buy this cool new bike that costs $100. You've been saving your allowance and you've got $20 saved up. So you go to your parents and you ask them to lend you the other $80, right? In this little scenario, your parents are basically the bank. They've lent you 80% of the bike's value. So your loan to value is 80%. You own 20% of that bike and they kind of own the other 80% until you pay them back. And honestly, that is exactly how mortgages work, just with a lot more zeros at the end. So why are banks so obsessed with this number? I mean, what's the big deal? Well, it all boils down to one simple word: risk. Lenders are in the business of lending money, and their number one fear is that someone won't be able to pay that money back. And this chart is a perfect illustration of how they think. See, if a borrower has a 95% LTV, the bank has a very, very small cushion. If home prices were to fall even a little bit and they had to foreclose, they could actually lose money. But now look at that 60% LTV loan. That borrower put down a huge 40% down payment. That creates a massive cushion. The home's value could drop quite a bit, and the bank is still totally protected. And here is the best part for you. This directly translates into a benefit. When a bank looks at you and sees less risk, they reward you for it. A lower LTV almost always means you're going to get a better interest rate and more favorable terms on your loan. It's really that simple. Okay, so let's see how this plays out in a real-world scenario. Let's compare two different buyers who are both trying to buy the exact same house. So the house costs $500,000. Buyer A comes in with a $100,000 down payment. That's 20%. So their LTV is that standard 80%. But then you have buyer B, who only has $25,000 to put down. That's just 5%, so their LTV is way up at 95%. Now, to a lender, these two buyers are like night and day. Because buyer B looks so much riskier on paper, the bank is going to protect itself. They'll likely charge a higher interest rate. They will almost certainly require them to pay for private mortgage insurance, or PMI, and they might even have stricter requirements for their credit score. Meanwhile, buyer A, with that lower LTV, gets the better deal across the board. This whole idea of the 80% LTV mortgage being the standard wasn't always the case. This concept really became a cornerstone of the industry during one of the most challenging times in American history, the Great Depression. Before the 1930s, getting a mortgage was a completely different animal. Buyers often had to put down 50% or even more in cash. Then the market just collapsed during the Depression, and banks lost staggering amounts of money. So to stabilize the whole system, the government stepped in. They created institutions like the FHA and Fannie Mae, which helped standardize the whole mortgage process. They're the ones who really helped establish that 80% LTV loan as the new gold standard. It struck a balance between keeping banks safe and making homeownership a realistic goal for more Americans. Okay, so we've covered the what, the why, and even a bit of the where it came from. So now for the most important part, how should you think about LTV when it comes to your own financial goals? The best way to look at it is as a spectrum of trade-offs. A higher LTV is great because it means you need less cash up front to get into a house, but it comes with more risk and usually worse loan terms. A lower LTV, on the other hand, requires a lot more cash, but you get more equity right away, you're a lower risk, and you get a better deal from the bank. And here's the key. Neither one is automatically better. It all depends on your personal financial situation and your own comfort level with risk. Real estate investors think about this stuff strategically all the time. They'll often use a higher LTV to get what's called leverage, basically controlling a big, expensive asset with a small amount of their own cash. But they know it's a double-edged sword. Too much leverage can be incredibly dangerous if the market turns against them. For an investor, it's always this calculated dance between growth and safety. So after all of this, if loan-to-value still sounds like a bunch of complicated financial jargon, just forget the term. Instead, just ask yourself this one simple question. Whether it's a house, a car, or that bike from our analogy, the real question is always this. How much of it do you actually own, and how much does the bank own? Once you understand the answer to that, you understand everything you need to know about one of the most powerful concepts in finance.